You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, Jackson Hole, it's that time of the year, and there's not even any snow on the ground, but I think you're going to be getting a snow job. The Fed is meeting there, and they got lots of fun stuff to tell you. And, well, our good friend Jim Welsh, macrotides.com, is with us. So, Jim, your take on this here? Rates are going up until they stop going up. You did some interesting research on unemployment numbers, how high rates have to go, how it affects unemployment, and then, of course, a derivative number of that is inflation, because that's why we're going through these machinations. What is your take on it?
Well, what I found, Kerry, when I went back to 1953, and I'm going to post the table that I'm about to reference with all the detail on my Twitter account at Jim Welsh Macro, so that'll make it easier for someone to access while they're listening to this to see the detail. But I went back to 1953, looked at all the various tightening cycles, and the level of the unemployment rate at the beginning of, in a sense, where did it trough before Fed tightening, and then what did it get to by the time the Fed was done tightening and the economy went into a recession? I excluded 2020 because of the pandemic. I also excluded 1994. Inflation was 3% that cycle, and obviously we're at a much higher level of inflation currently. So the bottom line was the average was about 3.6% increase in the unemployment rate. So if it was 4% on average, it went to 7.6. I looked at the two least or smallest increases. They were 2.1 and I think 2.5 in the 2000, and then the second cycle being 2007. And those increases, again, imply from where we are right now at 3.5 on the funds rate, is that we'll see the unemployment rate climb to a level comfortably north of 5%. Also looking at 74 and 79, which had inflation levels comparable to where we are today, the Fed funds rate went up 90% from where it had started from. So they're using 90% of 3.5. We're talking about a fund rate that would be north of 6%. So to me, this is what is likely to come. And the Fed, I think, is going to use a different approach, which I think Powell may touch on a little bit at Jackson Hole. But I think the bottom line from my take, Kerry, was the stock market is not priced for a unemployment rate above 5%. And I think the net result is that as we get into next year, the risk of a recession, I think, is going to, has been high. I think it has increased now that the Fed is definitely going above neutral. And that has been my take for months. No recession in 2022, but a recession in 2023, especially if the Fed took the funds rate above 2.5%. And they're definitely going to do that.
All right. So look what's happening with mortgage rates now. Look what's happening with real estate sales. Inventories up, highest they've been since 2009. Hard to believe. How much more of this medicine can the economy take?
Well, the flip side is if you look at the real funds rate, it's at like minus 6%. So the idea that the Fed is quote unquote tightened, gets stretched by that. Now, that's a function of the CPI. In the September macro tides, I go through and look at what's likely to happen over the next 6 to 8 months to the headline CPI. As we know, it hit 9.1 in June, dropped to 8.5 in July. I think we're going to see it close to 6% by the end of this year, and potentially by the end of March next year. The Fed funds rate the consumer price index will likely be under a 4% year over year number. If the Fed continues to raise the funds rate as they have projected to about 3.5 by the end of this year and a little bit more early next year, potentially the gap between the Fed funds rate and the CPI will be, approaching zero. So the point here, though, is that, at this point in time, the Fed has removed accommodation by getting the funds rate to a neutral level. Consumers in aggregate are still sitting on close to $2 trillion worth of savings. Granted, almost all of that is in incomes above 50% of the wage earners in this country. The bottom 20% have virtually no savings. So they're really getting hit hard by the combination of high prices, paying for rent, food, energy, and they've gone through their savings. So, you really have an unbalanced consumer, if you will. But job growth, 2.5 million so far in the first 7 months, wage growth over 5.5%. So the point being, Kerry, is you have some real stress areas in the economy. But overall, I have felt that those are the reasons why a recession starting this year was not likely and much more likely next year. And I still feel that's likely. That's the case.
Mm-hmm. So if you've managed to not blow through your life savings after what we've been through the past 3 years, what are you supposed to do? Just buy treasuries? I mean, because your real rate of return, you're getting destroyed.
Yes. Yeah. No, I think, again, when the Fed starts to raise rates, and to me, it was amazing. In December of last year, the Fed funds futures, and people like to believe that markets tell them information that is supposedly inside information and some kind of it, this is what's going to happen because the Fed funds futures are telling me so. Well, in November of last year, Powell told us that inflation finally, he admitted, not going to be transitory, it'll last longer. Sometimes people wake up later than others. The CPI had already hit a 39-year high in November of last year. And yet the Fed funds futures were only pricing in 3 quarter-point increases for all of 2022. So 3 weeks ago, what the Fed funds future supposedly was, and why this equity market rallied, was that the Fed funds future said, the Fed's going to take the rates up, and then they're going to start cutting them. There'll be 2 rate cuts in the first half of next year. And everyone is pointing to that as to, that's why the stock market's rallying. But look how wrong the Fed funds futures were last December. But now all of a sudden, people who are bullish want to believe that they've got it pegged perfectly. So, I think what the Fed has charted kind of a different course after looking at the 1970s, where they would hike rates aggressively, then slash them, hike and slash. It was referred to as stop go. My term is hike and hold. They're going to raise rates to 3.5-ish, and then I think they're going to hold them for quite a while, Kerry. And as monetary policy then subsequently, in a perfect world, slows the economy, but not too much, but more importantly, brings wage growth down and overall inflation down. That's the path they've chosen, and we'll see, if the global economy will allow them to actually persist in that path.
Is that really going to work? I mean, this is like a Rosie scenario.
Yep.
And you know how often Rosie's wrong.
I happen to like roses because my wife loves them, but you bring up a very good point. No, I think we're going to see a recession next year. Looking what's happened to energy prices in Europe, Europe is definitely going to be in a recession by the time we get into 2023. Overall global growth because of energy prices is going to be softer. China's a little bit of a wild card, but I don't think they're going to be adding, meaningfully to global growth, given everything that's going on there. So bottom line is, I think a recession is coming. And my take on the equity market is that I think, investors chose to believe that the Fed was, quote unquote, pivoting from raising policy. Okay. Because Powell didn't say after the July meeting that, yeah, we're definitely raising the funds rate by 75 basis points. So to me, that was a very, very, slim read to hang your hat on. I think Jackson Hole, the presentations there are typically high level stuff. That's in 2018. That's where Powell, stated that the Fed had adopted average inflation targeting. So it's kind of macro type things that they talk about. He's not going to get into detail in terms of what they're going to do at the September meeting. I'm in the camp. I think they go 50 basis points in September and continue to raise rates in November and December. But it really is going to come down to, Kerry, whether the market hears the more hawkish tones. We're going to keep raising rates, and then we're going to hold them up there at a high level for a longer time. Or, hey, he didn't say they're going to raise rates 75 bips at September, so let's rally the market. I think there's another push higher coming in the stock market that could exceed the highs of last week, because the jobs number is definitely going to be quite a bit weaker than the July employment report, which showed 525,000 new jobs. The CPI is going to come down again, and that ought to really get people going, yeah, the Fed's only going to go 50 basis points. So I'm looking for the market to rebound into September, maybe early October. And then I think the music of, hey, we are going to go into a recession next year is going to result in another pretty good decline and potentially at a minimum a retest of the June lows. So that's my outlook for the market, and possibly, as low as 3,200. You never know until you get there. I'm assuming that if the S&P takes out the June low, that there'll be some additional selling pressure that shows up. Because there's a lot of people who thought and think that the low is in on this bear market, and I'm not in that camp.
Okay. So basically, if I summarize what you said, we're just getting started here, but that's all subject to change without notice, right?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near two producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold two companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
But isn't that always the case? I mean, that's why, I use technical analysis a lot. I mean, I believe, as we've been talking about fundamental stuff. But that's why one has to use technical analysis to kind of check whether or not the narrative that is either going on Wall Street is accurate or not, and whether my outlook is correct or not. To me, technical analysis is the objective arbiter. I think the rally from the June low so far is just three waves. If I'm right and we see a deeper pullback over the next week or so, and then a subsequent rally up into 4,400, maybe 4,500 in September, in anticipation that the Fed's only going to go 50 bips. Again, the recession, I think, is looming in 2023. Earnings are going to come down. The market is overpriced for that outcome. And that's why I think there's going to be another decline. The technical stuff will really help identify, which path the market is going. But that's, to me, what it looks like right now when I tie fundamentals with the technicals.
Okay. Interesting. And I guess time is going to tell. Jim, when we take a look next year, next summer, we're in a recession. What's the unemployment rate at? 5+%? And
yep.
And are they going to start cutting at that point? What's the CPI at that point? Is it down to a measly 7% or is it down to 2%?
Well, again, I think by the end of the first quarter, the CPI will be under 4%. So again, some of this is just the mathematics, Kerry, of how much did it go up in 2022? And now we're going to subtract that. So in January, February, and March of this year, the CPI, the month-over-month increases, was 3%. So unless you're replacing new increases in January, February, and March of 2023, if the inflation was flat in those 3 years, the CPI would drop by 3%. So my point is there's just the mathematics of reverse base effects is going to subtract a fair amount out of inflation. To me, the overall theme, for me at least, is inflation is going to come down, but it's going to hold at a much higher level for two reasons. Labor market tightness is going to persist. Labor participation rate peaked in 2001. It's been trending down for 20 years. In the 1960s and 70s, when we had that last surge of inflation, women entered the labor force. Their participation rate went from 43% to 57% in the early 1980s. That, I think, helped keep labor inflation low after the 82 recession. The other point, energy. In the mid-70s, OPEC took oil from $3 a barrel to 12 in 74 to 39 in 79. What happened? U.S. oil and gas companies increased their investment in drilling and exploration by 5-fold. The net result is we got a lot more oil. Oil went from 39 in 79 down to $10 in 1985. And in 2010 to 2014, oil was between 85 and 110. Fracking brought oil supplies to the market, and we saw oil prices drop to the $45 range in 2015 and 16 and stay under 60 until, for the most part, until last year. My point is that labor market tightness is going to persist because we don't have a big group of people like women joining the labor force that took place in the 60s, 70s, and early 80s. And we're not going to do anything close to the drilling that happened in the 70s or fracking in 2006 to 2014. So to me, that implies, hey, we're going to see energy prices remain higher for longer than they otherwise would because the market response that helped in prior, high price environments is not going to be used, globally and in the U.S. There is such a really clampdown on any new fossil fuel production that this is going to be problematic. And we're already seeing it manifest in, obviously, Europe. Natural gas prices, while they were against fracking, so was Britain. Their energy prices are going through the roof. Also, disdain for nuclear energy. Despite everything that's happened, Kerry, it's amazing. Germany yesterday decided, no, we're not going to keep those 3 nuclear reactors open. So they've gone from 17 to 3. They're going to go to 0. And in the meantime, and this is being driven by the Green Party of Germany, they're going to tolerate much more usage of coal, which is way more, in terms of emissions, far more intense than nuclear and even natural gas. So to me, we have 2 viruses. We have the COVID virus. We all know that. We also have a climate change virus that is precluding us to choose a path that balances reducing emissions, but not kneecapping economic growth.
Yeah, good luck there.
So I know it's not going to change. In the meantime, China and India will continue to build new coal-fired plants and offset whatever reductions in emissions that the U.S. and Europe, which already is happening. I mean, U.S. emissions have been plateauing for the last 15 years because of fracking and the cut in oil usage. But all those improvements are being offset by increased emissions from China and India. So if one doesn't approach this globally, I just think you're being myopic, and we have a lot of people that need glasses at this point in time.
Isn't that the truth? All right.
Yeah, I think so. One last thing on gold. I think there's another pop coming. I thought buying gold in the low 1700s over the last month made sense. I'm looking for a rally to 1850 to 1880. And if it fails to break out above that, then I think gold, could have another pretty good sinking spell. But I'll take that. I'll get there. I'll make that call when we get there. First of all, we got to get up towards that 1850, 1880 level.
Got it. All right. Interesting news from our good friend Jim Welsh of macrotides.com. Make sure you go over to the site, sign up for his newsletter, sign up for ours, financialsurvivalnetwork.com. Just click the newsletter tab and you will be signed up. And if you got a question for Jim, shoot us an email, kl@kerrylutz.com. And I'd like to know what your opinion is. Where do you see inflation coming? Do you think energy prices are going down? And what about the market? Are you a bull? Are you perma bear? Or are you somewhere in the middle? We'd like to know. kl@kerrylutz.com. Thanks so much, Jim. Always a pleasure. We'll talk to you again next month.
Thanks so much, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.